Everyone is calling this a collapse, but collapses don't look like this. What we just watched was not a market losing belief. It was a market being forced to obey. Silver didn't drift lower. It didn't roll over. It was driven straight down in a single violent move that erased decades of reference points and hours. 31% gone in one day, the worst daily loss ever recorded. And when something breaks records like that, the instinct is to assume chaos. But chaos is sloppy. This wasn't sloppy. This was surgical. When a market truly panics, sellers appear everywhere. Physical supply comes back online. Premiums vanish. Dealers get flooded. Instead, something very different happened. Futures prices collapsed while real metal refused to follow. Delivery weights stretched. Physical premiums detached. Buyers stayed active even as screens bled red. That is not fear. That is stress in the pricing mechanism itself. To understand this move, you have to understand how modern commodity markets actually function. Futures markets are not primarily about metal. They are about leverage. They are about positioning. They are about margin. When liquidity tightens and leverage gets uncomfortable, price becomes a tool, not a signal. You move it fast, you move it far, and you let the system do the rest for you. On the day of the crash, nearly 2 billion ounces of silver were traded through paper contracts. 2 billion ounces in hours, in a world where annual mine supply doesn't even reach half that. No metal changed hands. No trucks moved. No vaults filled or emptied at that scale. What moved was risk. What moved was leverage being flushed out of the system. That volume alone tells you this was never about discovery. It was about clearing. When that much paper hits the market at once, the outcome is predetermined. Stops get triggered. Margin calls cascade. Forced selling accelerates the move. Traders don't exit because they change their minds. They exit because they're no longer allowed to stay. And once that forced selling is complete, price magically stabilizes. That's not magic. That's mechanics. At the exact low of the crash, a major player closed a large short position. Not later. Not on a bounce. At the low. And from that moment, the selling pressure evaporated. Price didn't need good news to recover. It just needed the selling to stop. That timing tells you everything. Large institutions don't guess bottoms. They see the flows, they see the margin thresholds, and they know exactly when the liquidation engine is empty. They don't chase price. They create conditions. If this were truly the end of the silver story, physical markets would have cracked instantly. They didn't. Physical silver in Asia continued trading far above futures prices even after the biggest crash in history. Premiums didn't compress. They stayed wide. In normal sell-offs, premiums disappear because sellers panic. This time, sellers didn't show up. Buyers did. That's the part that should make you uncomfortable if you're only looking at charts. This move also didn't happen in isolation. Liquidity stress has been building across the system. The first bank failure of the year just occurred. Not a giant institution, but the first crack always matters. It shifts psychology. It raises questions about counterparty risk. It makes leverage feel dangerous instead of clever. At the same time, political and fiscal uncertainty has been rising. Government funding risk, leadership changes, and policy ambiguity all tighten financial conditions even before anything officially breaks. In that environment, the first reaction is always the same: raise cash, sell liquid assets. It doesn't matter what the asset represents long term. In phase one of stress, liquidity wins. That's why gold and silver get hit first. But phase one is not the destination, it's the purge. After forced selling, the market doesn't immediately reward patience. It punishes it with boredom. Price drops. Narratives stay bearish. Confidence stays low. That's how markets make sure participation remains thin, while pressure quietly rebuilds underneath. The most dangerous assumption right now is thinking that because price fell hard, the problem was solved. It wasn't. No new supply was created. No real demand was destroyed. If anything, lower prices increase physical demand while discouraging future production. That makes the imbalance worse, not better. This is where paper markets and physical markets begin to diverge more aggressively. Paper prices can hover, stall, or even retest lows, while physical buyers continue accumulating quietly. That divergence does not last forever. It resolves when confidence in the paper layer erodes enough that price must rise to clear real demand. That resolution is never gentle. None of this is an argument for reckless optimism. Volatility like this destroys traders. Margin hikes after crashes only add fuel to the fire. If you're operating with leverage, this environment is hostile and unforgiving. The market does not care how strong your thesis is. It cares whether you can survive the path. But survival and understanding are two different things. What just happened was not the market rejecting precious metals. It was the system revealing how fragile the paper structure has become under stress. When years of global production can be dumped into the market in hours without any metal appearing, price stops being a reflection of value and starts being a pressure valve. Pressure valves release stress temporarily. They do not eliminate it. This was not an ending, it was a reset, a violent one. And markets that reset this aggressively rarely move sideways for long once reality reasserts itself. The question isn't whether this move was extreme. It was. The question is whether it resolved anything. It didn't. After a move like this, the most dangerous thing you can do is assume the market owes you clarity. It doesn't. What usually follows a violent flush is not immediate relief, but confusion. Price stops trending. Volatility compresses just enough to make people second-guess themselves. The same participants who were panicking hours earlier suddenly feel nothing, and that emotional numbness convinces them the event is over. It almost never is. What actually changed during the crash was not belief in silver or gold, but ownership and exposure. Weak hands were removed. Over-leveraged positions were erased. The remaining participants are either underexposed or structurally aligned with the asset itself, rather than the trade. That shift alone alters the market's behavior, even if headlines don't. And while attention stays glued to the chart, the physical side continues operating on a completely different clock. Fabricators don't cancel orders because futures spiked lower. Strategic buyers don't wait for permission from technical indicators. When price drops below what real users consider fair, accumulation doesn't announce itself. It absorbs supply quietly. That's why physical premiums staying elevated after a historic crash is such a powerful signal. It means sellers are still scarce. Lower prices do not solve shortages, they often amplify them. They stimulate demand while discouraging marginal supply, especially in markets where production responds slowly and capital investment takes years to materialize. That dynamic doesn't show up immediately in price, but it builds pressure that eventually has to express itself somewhere. This is where paper markets become vulnerable. Futures pricing works smoothly when most participants are content to roll contracts and settle in cash. It becomes unstable when confidence fades, and more participants want exposure tied to real metal instead of paper claims. That shift doesn't need to be dramatic to matter. It only needs to be persistent. After forced liquidations, the system often buys time. Price may stall, it may drift, it may even probe lower levels to see if sellers are truly exhausted. This phase frustrates everyone. Bulls feel early, bears feel unsure, neutrals disengage, participation drops. And that is precisely when pressure begins to rebuild, unnoticed. Another layer that matters here is psychology. Historic crashes imprint fear. People remember the pain long after the mechanics have changed. They anchor to losses and wait for certainty that never comes. By the time the market feels safe again, price has usually already adjusted. That's not an accident. Markets don't move when confidence is high. They move when positioning is wrong. None of this eliminates risk. There could be more volatility. Margin increases can force another round of selling. Liquidity stress rarely resolves cleanly in one act. Anyone pretending this is a straight line recovery is lying to themselves. But acknowledging risk is not the same as misunderstanding structure. Structurally, nothing about this move fixed the imbalance between paper volume and physical availability. When massive amounts of synthetic supply can be created and destroyed in hours, price becomes an instrument of control, not a mirror of reality. That works only as long as confidence in the system holds. Once that confidence erodes, the adjustment is rarely gradual. The second phase doesn't look like panic. It looks like disbelief. Price starts moving without headlines. Pullbacks don't follow through. Physical premiums widen instead of compressing. Inventory stops responding to price. These are subtle signals, and they're easy to miss if you're waiting for confirmation from the same tools that failed during the crash. The market is not obligated to reward everyone who endured the pain. It only rewards alignment with reality. And reality is defined by what exists, not by how often it can be rehypothecated on a screen. What we just saw was the system showing you how it defends itself under stress. It deflates paper claims aggressively, clears leverage ruthlessly, and restores short-term order through force. What it cannot do is manufacture physical supply or eliminate long-term demand. That's why these events are remembered later as turning points even though they felt like disasters at the time. Not because price fell, but because the structure underneath was exposed. If you're looking for certainty, this market won't give it to you. If you're looking for signals, stop staring at the candle and start watching what refuses to break. Because the most important information is rarely where the noise is loudest. Silver didn't fail, the pricing layer did, and layers that fail under stress tend to get repriced, not repaired quietly.